Warren Buffett's 7 Principles for Successful Investing. Warren Buffett is considered one of the most successful investors and one of the richest people in the world today. He centrally shaped the investment strategy of value investing and implemented this together with his partner Charlie Munger in his investment company Berkshire Hathaway. Warren Buffett repeatedly comments on his investment principles in interviews or letters to shareholders. This video is about the 7 principles and rules that shape Warren Buffett's investment strategy. Number 1. Buy and hold. The majority of investors in the stock market media are hectic. People are constantly trading back and forth and speculating where the market will be next week. Short-term decisions dominate. There are several reasons for this. Stock market media and banks only earn money when there are always new headlines. And many investors who are more speculators like to gamble, as scientific studies have shown. Warren Buffett repeatedly emphasizes the advantage of the buy and hold investment strategy, an investment strategy in which you act as passively instead of actively as possible and invest with a long-term focus, and accordingly hold it for the long term. Number 2. Understand the company's business. Many investors are looking for stock tips. It is not by accident that many stock advertisements have titles such as, "This stock is about to break through," "The 5 stocks for 100% plus returns in the next few months," and similar dubious promises. Behind this is the desire for little work, a lot of income and the belief that some investors have these insider tips and glass balls that could predict such returns. That is of course nonsense. The path to successfully investing in individual stocks is more complex. You first have to understand a business in order to be able to judge it. Only then can you assess the opportunities and risks that you are taking on a potential investment. And only then you feel comfortable with an investment even in times of crisis. Number 3. Focus on the business model. Building on the previous principle, Warren Buffett repeatedly emphasizes the importance of a strong business model. On the one hand, you should understand the business model, on the other hand, you should be on the lookout for strong business models. Number 4. Quality beats evaluation. To buy a stock, 2 things have to be right: the quality and the valuation. A good stock can be valued too dearly, and therefore unattractive. A mediocre stock can be valued too cheaply, and therefore attractive. The question is always, how high is the quality, and what is the price for it? Warren Buffett summed it up in a quote: "Buy $1 but don't pay more than 50 cents for it." Number 5. No short-term speculation. Many investors and especially traders enter into short-term speculations. Some of them are not convinced of the investment they are putting their money into. They follow the greater fool theory. "I'm sure I'll find another idiot who'll buy my stock for an even higher price." According to Warren Buffett, this is a big mistake. A share that you are not prepared to hold for 10 years you shouldn't hold for 10 minutes. Number 6. Be tolerant of risks. As an investor, you are put to the test. Prices fluctuate, ideas come and go. A certain tolerance towards the risks is therefore essential. Warren Buffett defines a rule for this: never buy a stock if you can't live with the price halving. After a stock valuation, you may be euphoric about buying a stock and expecting the market to recognize what you've seen. But a share can fall at any time. In the short term in particular, share prices are difficult or impossible to predict. So before you buy, and also before you sell a share in panic, always be aware that the stock market and individual shares can lose value at any time. You will earn money in the long term as compensation for taking on these phases. Number 7. Focus instead of excessive diversification. Diversification is an important basic principle of any financial investment. Spread your investments in order to minimize your risk. Diversification is the point at which many investors make mistakes and unknowingly take excessive risks that are easy to avoid. Warren Buffett is a believer in diversification, too, but does not recommend excessive diversification, and also emphasizes the focus for investors who know what they are doing. Focus your investments. If you have a harem of 40 women, you don't really get to know any of them. As soon as you observe too many individual stocks, it becomes even more difficult to really understand the business models and to identify important developments. Conclusion. Be interested in the companies you invest in, spread your risk in a few, manageable, companies and hold your shares for the long term. With that being said, take your chances and invest smart.